Hi, everyone. So this talk is called The Sorry State of DeFi Security, which is, of course, a very provocative title. But I do think that we are at a point in security or in DeFi where the number of incidents that we see daily almost is becoming ridiculous. And it's turning into a reputational problem for the whole ecosystem. So before I start, just a little bit about myself and the company I represent. So I'm Stefan Beyer. I have a background in distributed systems research and then moved into cybersecurity. And now I'm the lead auditor at Solidified, a US company. And I'm also the CNO of CRYPTONICS, which is a European company. And I specialize in smart contracts and full stack blockchain security audits. So Solidify, we are a company that has been auditing smart contracts since 2017, and we also have been running bug bounty programs. Right now, there's over $500 million of assets under code we've audited or on our audits, more or less, it's an estimation, of course. And what we do is we are a community, right? So we're a community-driven company, and we have about 250 security experts on our platform that look at bug bounties and smart contract code. Okay, so as I said, I want to talk about DeFi and the security problems we are seeing there. And of course, the first question is, what is DeFi? And I'm sure in this conference here, I don't have to explain too much about it, but just in case, very quickly, DeFi is an implementation of a traditional financial instrument or instruments on services or on a decentralized ledger platform, on a blockchain, right? So I put traditional here in parentheses because there are some financial instruments that are not so traditional, and those are the ones that are of particular interest in DeFi, right? That they introduce some interesting problems from a security point of view as well. And that's a quick overview of different DeFi products. You know all this, I suppose, but very quickly, there are stable coins which can be fiat backed or something like MakerDAO's DAI, which we've just seen an excellent presentation on. There are things like decentralized exchanges, which can be order book based or automated market makers. There are lending pools, there are insurance products, and then there's this whole other bag of things which I call securities, even though people don't like to call it securities, but things like, crowdfunding participations, investment pools, funds, so a mix of investment related things. And usually what is very fashionable now is if there's liquidity pools and market maker involved, there's things like liquidity mining and yield farming, right? So that's what we commonly know as DeFi right now. So before I want to go into the particular aspects of security, I want to say that decentralized finance in many cases, not in all, but in many cases might be a misnomer, right? Because DeFi is really not as decentralized as you may think in all cases. So first of all, when you use one of these lending protocols or anything like that, you usually get a stable coin out, right? So you put a more volatile asset in and you get a stable coin out. That's a common use case. In any case, a lot of DeFi protocols deal a lot with stablecoins. And there are some really decentralized stablecoins like DAI we've just seen, but a lot of them are really fiat-backed, collateralized stablecoins, which are backed by a centralized entity. Things like Tether, USDC, whatever they are called, there are many of them. And what many people don't realize, apart from that, they obviously rely on a company acting honestly and their auditors, real-world auditors acting honestly. These smart contracts are usually pausable. They can be stopped by some privileged role. They have privileged roles for freezing, wiping balances, and they can blacklist individuals, right? So they're fairly centralized, and they produce a degree of centralization in many protocols. And then when you want to deal with other blockchains, not just, well, usually we are working on Ethereum, but There are newer platforms now coming out that have DeFi applications, but usually on a single protocol. So if you want to deal with other blockchains, you have to use wrapped assets like WBTC, which is a very good project, but it is a centralized bridge and it requires KYC. So it's not exactly in the spirit of decentralization. And finally, there's a bit of shaky governance involved sometimes. And I say shaky because the token holders of these, governance tokens like the Uni token and the compound governance token and all these things, they're very fashionable now, and then they're very good, but they have an essential problem. And it's that the people that hold these tokens are very often much more interested in speculating than in the actual governance of these protocols. And that's obviously not true for all protocols, right? But it does happen, especially with smaller protocols. And this leads to a lack of quorum. We've all seen these examples where on Uniswap governance votes would have passed with a percentage of votes they got, but they didn't reach quorum because not a lot of people were interested in voting. And the answer of this is, of course, to lower the quorum. But if you lower the quorum, you also introducing a lack of democracy, so to speak. And then there's obviously protocols that have a very fair distribution model, but there are also protocols that have unfair distribution, and that happens quite a lot. Like developers or the original team and their friends having large shares of the governance token right from the start, and that obviously means that there's some centralization in the governance model there. We've seen a few examples of this ourselves when there was voting going on for which company should audit a certain protocol. It's not always as transparent and decentralized as it should be. But anyway, aside from that, I don't want to talk badly about DeFi because there's some really good projects out there and some really decentralized finance protocols. But there's also a big security implication, not just of the centralization of the way the whole space is now going. And let's just look at an example of a DeFi project timeline, right? So on a Tuesday evening, some smart contracts are deployed. On a Wednesday afternoon, there are $580 million locked into the smart contracts. On a Wednesday evening, on the same day, the Wednesday evening, a bug is discovered. And by Thursday, the price has completely collapsed and a lot of early adopters have lost all their money or a big chunk of it. Now, I'm not making this up. This is a real case, right? This has happened. And the protocol shall, of course, remain nameless, but it has happened, right? Similar example, right? Fairly recently, a project raises $4.3 million in order to develop a slippage-free DeFi protocol. And then they go off and then they deploy a fork of an existing project. Obviously, there's some modifications, but essentially they base everything on an existing project. And that already raises a few flags because I'm not sure why you'd need $4.3 million to do that, right? But within 6 minutes, early adopters lose 7.9 Bitcoin, which is quite a lot these days, due to slippage, which is, for a slippage-free protocol is obviously a big problem. So this has also happened, right, fairly recently. And again, I won't name the protocol, but there's pictures here. So why is this? And as an auditor, we see many things, and there are a few concerns we particularly have. And my first concern is the complexity of these projects these days. They're very large code bases with complex designs and very complex mathematical models, which can lead to bugs in the logic. And the separation of concerns in these complex designs becomes very difficult, meaning that not many people understand the whole protocol completely. And it's just impossible to guarantee anything about it. And I mean, I said before, the make at our project, if you've just seen an architecture diagram of in the presentation before mine, I've already said it's a really good protocol, but the complexity of it is just astonishing, right? That has to be a security concern on any project. The next point is these protocols are meant to be used in combinations, right? So there's protocol composability, which means one protocol uses another, and these smart contracts interact with each other. And that means that there are unexpected use cases that suddenly emerge. And we saw that this when the flash loans first came out, right? So nobody expected how these would be used, or maybe someone did expect how they would be used, but a lot of protocols were not prepared for it. And there's this ripple effect of something falling over, affecting other things. The protocols right now usually have stablecoins involved, and that means they have to map prices, but of more volatile assets to these US dollar or whatever the stable coin is pegged to price. And it means we rely on oracles, right? So oracles are dangerous in that they can lead to oracle price manipulations, not just through flash loans, through other means as well. And we've seen several incidents of this. Another problem with oracles is they might disappear, right? We've seen that happening when protocols came to us, and suddenly the MakerDAO price feed they used, the old one, was switched off, and they didn't get any price information into their protocol anymore. So that's obviously something that can happen. And in order to deal with these things, people come up with very complex oracles and combination of oracles, and complexity is always the enemy of security. So that can cause problems. In general, there's a lot of time pressure. The speed of innovation in this space is very fast. There's a bit of a gold rush going on. Anyone wants to take part of this, and this leads to not enough testing being done. There's a big difference between testing and auditing, and one testing catches certain things, auditing doesn't, and the other way around. So there needs to be time to do all these things. And there's also immature tooling, right? So the tools we use to build these protocols are very new, and they keep changing. Starting with the Solidity compiler, which sometimes has bugs, and Solidity is not the most mature language, in my opinion, anyway. But we do rely on a lot of immature tooling still. And finally, and this is very important, there's a lack of experience, right? It's very difficult to find good developers, simply because there's this gold rush going on, and there are not enough people that are real specialists in writing secure smart contracts. And we noticed this with running an auditing company. It's very difficult to find good auditors, and the wait lists. People are struggling to find firms that can take them on relatively quickly because there are backlogs. And in general, there's a lack of knowledge related to security, which is because a lot of people are from a different background in DeFi, not from a security background. So to go back to what I said about DeFi composability, right? So here's a nice example of how a lot of protocols interact, and in a way we sometimes don't even realize. Let's say I want to use Curve, and I want to provide liquidity to the Y pool, fairly standard operation on Curve. So I put in my DAI, my USDC, my USTD, and my DUSD into the smart contract, which in turn puts it into Yearn Finance. And Yearn Finance balances it out, moves it around between Compound, DYDX, and ARV, or RB, well, not sure how to pronounce it. But that does involve a lot of smart contracts from different protocols, right? So there's a smart contracts of 9 protocols involved, 3 of which are centralized entities, right? USDC, USDT, and TUSD are possible smart contracts controlled by a single entity, right? Or each of them controlled by a single entity. So that's obviously an example of how a Curve user might not realize what is going on below the hood at first sight, and the complexity is quite astonishing. So with all this in mind, how can you build a secure DeFi protocol? So there's a number of guidelines, and the most important thing is to realize that you are building financial software, right? And financial software is critical software. So the first thing you have to do when you build the financial software is to get a domain expert, right? A financial expert, an economist, rather than an engineer. And that's what a lot of protocols don't do. They're very capable programmers. They get their bonding curves or whatever. They read a bit and they try to implement them. And then the model might not work in all circumstances, right? Because you're lacking the domain expertise. And importantly, and it's very important for us at auditors, we need documentation and specification of these financial models. And your engineers will also need this, right? So there's a big difference between an engineer and an economist, and the way they communicate and the way everything is documented is very important, because the programmer very often implements something which is not quite what the domain expert had in mind. And we know this from other software, right? It's nothing new. Importantly, slow down. I know there's a gold rush going on. Everyone wants to be in on it. But financial software has been built for 50 years, since the 1960s, I suppose. And there's a reason it moves slowly, right? It's very critical and it's easy to get wrong. So traditional financial software doesn't move slowly because people don't want to innovate. It moves slowly because there are severe security risks involved with this. You take your time to do things properly. And that involves testing, right? We do get a lot of code in our audits that hasn't gone through testing, and there's unit testing, integration testing, user interface testing, end user testing, and there's things like fast testing of your mathematical implementation of your mathematical models. There's a lot of testing you can do, and it can be very powerful. And then, you just have to keep it simple. The complexity is not always the right solution. I know these things are complex, but some implementations are excessively complex. And it's better to leave out a certain feature you think 1.5% of a user base might make use of if it complicates the protocol too much. And that's very related to incremental innovation, build on something that works and added something new, something innovative, but don't just innovate the whole space at once, because it's bound to go wrong, right? So once you've done all this and you are programming and you are doing things slowly and properly, the next thing you can do is to integrate security tooling. Right, and here's like a bit of a classification of security tooling you can use. So there are very good testing frameworks out there, things like Waffle and Truffle. Unit testing is essential. You can calculate the coverage. I put a question mark there because 100% coverage doesn't really mean that much, but it's a useful metric. But you can integrate all this into your build pipeline, right, and do automated testing. The same goes for static code analysis, things like Slither, very good tool. And static code analysis has become very good at finding what we call the usual suspects, things like reentrancies, overflows in smart contracts, things that are known vulnerabilities. And the downside is there are a lot of false positives, but it's something you can deal with. You can look at them and just discard them. Then the symbolic execution, which is very good for exploring different execution states. It's fairly slow. Tools like Manticore. I have to admit, I don't use them myself, so I'm not the world's best. Well, I'm not the expert on symbolic execution, so I don't want to talk too much about it. But finally, there's fast testing, which is very useful for testing complex code bases. And what you can do is you can focus on the mathematical model, for example, and detect assertions that are not met with certain almost random values, right? The downside is it needs instrumentation to be useful. So you have to actually go through the code and put this assertion in there. Otherwise, it's a bit random, more random than random. But yeah, if you put in the time, you can get very good results with fast testing. One thing to note about security tooling, specifically things like code analysis, is that it's what we say ideal for the type of projects we saw 4 years ago, right? So the usual suspects. It doesn't look at your logic and finds bugs in there. But once you've done all that, you should get, obviously, your smart contracts audited. And of course, I would say that as a smart contract auditor, but most teams now realize that a smart contract audit is the way to go. Very quickly, I want to talk about how smart contract auditing is done now and how it has changed since I first started in 2017. So back then, most projects were tokens, ICOs, and now they are almost exclusively DeFi protocols or layer 2 solutions. Maybe sometimes the smart contracts offer interoperability bridge as well. But the number of lines of codes is much higher, much more complex, much more dependencies, Oracle dependencies. We have to deal with composability between protocols. We audit a protocol and we have to know another one that is used. And the type of bugs and vulnerabilities we find are different, with a couple of exceptions, which are re-entrancy and block gas limit issues, which keep occurring. Even now in 2021, we're still finding a lot of re-entrancy issues. This is an example of my first audit. I don't expect you to understand the code. Many of you will, but basically what I want to show is that was 2017, my first audit. There was a potential overflow, and that was about the only issue I found. And that's an example of a more recent audit. And here we talk about the unclear governance system. We are talking about interaction with third-party projects that are an issue. And we are talking about oracles. And we are talking about potential price manipulation, all in a single issue. So the issues themselves have become much more complex, right? And these are the statistics of what we tend to find in our audits. We looked at all the audits we did between January and September 2020, and that's 9 months of data. And most of these were DeFi and some layer 2 solutions. And there were 40 projects, including Hermes, Loopring, B Protocol, Origin, big projects, complicated projects. And logical errors in the code were what we most found. Simple bugs in the logic. It's impossible to detect automatically in a static code analyzer. And that's very related to unauthorized access here. These went 20%, which is really unauthorized access related to a bug in the logic. Right? And interestingly, 16% are in reentrancy. So 5 years after the DAO hack, we're still finding a lot of reentrancy vulnerabilities, which is interesting. But don't just leave it there. Once you've done a smart contract audit, you should also run a bug bounty program. And a lot of companies do this these days, and they use their GitHub, their Twitter, or to announce this. But it's difficult to engage the right type of people, right? And that's where we come in with our bug bounty platform, which has been operational since 2018. It's a place where you can upload your smart contract, define a bug bounty, and it's run on-chain. And there are about 250 plus blockchain security experts just waiting to look at your bugs and find them. And it's been on the test net for a while, and we've paid out 4,000 plus ETH in real ETH, but running the actual protocol on the test net for testing, obviously. And we are now ready to launch in early summer. We're just pending the final security audit, which is obviously being done by another company, by one of our competitors, for obvious reasons. And there's a sign-up link here, which I will post in the comments, in the chat as well, where you can get news on the launch and sign up, basically. So before I end all this, I just want to mention this other problem here. Once you've done everything we talked about, you've done your homework, you've developed in a secure way, you've used the correct tooling, your smart contracts are as secure as they can be, you still have to deal with this problem here, which is what happened to me when I first tried to experiment with UN Finance, right? I typed UN Finance in Google, and the first link that popped up, someone who temporarily managed to place first in the Google search list, presented me with this website where I clicked on Connect Wallet. I tried to connect my wallet, and then I was suddenly asked to enter my secret 12-word phrase, my seeds for my wallet, which is obviously a scam to get hold of my private keys. And I didn't go for it, obviously, but a lot of people do. And there's a whole range of problems beyond smart contracts to do with blockchain security that if you are interested, I will talk about this in about an hour's time when I do another talk. So please, if you like to hear about this, tune in again in about an hour, right? So just to finish off, one thing I would like to mention is that we are currently looking for more auditors for our team. So we are hiring. We have a team of core auditors from the community that we frequently work with, and basically, obviously, you need to be a Solidity smart contract programmer, have the relevant development experience. You need to have a strong understanding of the Ethereum virtual machine, best practices. You need to know about DeFi these days, about oracles, and you should know the tooling involved in, the Slither, Manticore, these type of tools. So send your CV here. There's a link, and we're happy to talk to you if you have the right experience. And it's an exciting place to work, both full-time and part-time. Mainly, most of our auditors are not full-time, so it's quite a good place to get to audit smart contracts.